Self-destruct sequence activated. 3, 2, 1.
Is this your homework, Larry?
Just ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
All right, welcome to chapter 6. We're starting to put everything together, and I think, once you are able to master technical analysis, the idea of knowing how to manage your risk and having a plan before getting into any type of trading is really going to be crucial to your success, and that is exactly what we are going to go over here in chapter 6. This lesson is going to be all about putting your plan together. All right, so some key takeaways from this lesson. First and foremost, having a plan is essential for achieving trading success. Trading plan should be written in stone, but is subject to reevaluation and can be adjusted along with changing market conditions. A solid trading plan considers the trader's personal style and goals, and knowing when to exit a trade is just as important as knowing when to enter a trade. Stop loss prices, profit targets, they should be added to your trading plan to identify specific exit points for each single trade. Okay, so just consider some of the following when you are putting your trading plan together. So it should be a written or typed out document that you can reference at any point in time during your entire trading journey. It's really important to take this. It's really important to approach this entire journey you're about to go into as a business. Think of it as you are starting your own business. Now, if you don't have a plan in business, you're basically planning to fail. Discipline is going to be very important, and I promise if you can stick to your plan, if you're not successful in the beginning, you will be able to identify areas of weakness and hopefully correct those areas of weakness in building your plan. Okay, so some things that you should probably include when you're putting it together. One would be your trading goals and your projected return on investment, your performance results. So you should be keeping a daily log of every trade that you enter and exit. And for reference, I have put one of those together, and you can download that at the top of this chapter. It is a pretty in-depth, detailed Excel sheet, and you can use it in Google Sheets as well. You should have your clearly defined trading strategy. You should have your clearly defined risk management strategy. You should have clearly defined trading conditions for when you should be going in and out of trades. You should have back testing results that support your hypothesis on a trading strategy. And as we mentioned, record keeping. Record keeping is very important because you want to be able to replicate positive results and modify negative results. All right, so moving on. So again, as we've discussed, being a successful trader is very comparable to being a successful business owner. Now, the more organized, disciplined, focused, and determined and motivated you are, the more likely it is that you will succeed. Now, one thing to keep in mind when putting your trading plan together is that trading is a game of probabilities. Your only job is to find probable trade entries that fit within your trading plan and risk tolerance. Taking unnecessary trades due to FOMO or lack of discipline will cause you to lose your entire account. I'm going to read that again. Taking unnecessary trades due to FOMO or lack of discipline will cause you to lose your whole trading account. Now, remember, we are in a Bitcoin bull market. If you're trading crypto right now, this is one thing to keep in mind at all times. Not losing is winning, especially when we are in a bull market. The price is rising. Bitcoin is becoming more and more valuable in time. So capital preservation should be at the very heart of your entire plan. You wouldn't start a business without making a clear plan, now would you? Or go on a hike across the desert without water, map, or a compass. Basically, the idea here that I'm trying to get across is you need to plan. You need to plan for your success, and if you don't, you're planning to fail. So some things to keep in mind when putting together your trading plan, and we're going to run through each one of these individually. So first, you're going to want to assess your risk tolerance. 2, keep detailed records. 3, review your records regularly. 4, know your strategy. 5, study the market environment as it's dynamic and constantly changing. You're going to apply strict risk management rules. Define your entry and exit prices before taking a trade. Define your trading style. You need to know if you are going to be a day trader, a swing trader, or a position trader. Now, typically, the beginning trader should start on the most risk-averse trading style, which would be position trading. However, if you are very eager to get in and start making some trades, my recommendation is to paper trade or practice trade. That way you can define a successful strategy. Then before you start risking real capital or real Bitcoin, you know exactly what you're getting yourself into. It's very important to pay attention to market fundamentals. As I said, we are in a Bitcoin bull market. Things are just going against all probabilities. Bitcoin is breaking bearish patterns to the bullish side, and it's happening quite often. You need to be very precise with your risk reward ratio and potential trades. You need to define your maximum risk margin per trade. You need to know exactly where and why you're placing your stop losses where you are. You need to define your confirmations. So as you put together your strategy, once you identify a good candidate to enter into a trade with, you should have defined confirmations before entering into a trade or exiting that trade. You need to understand different order types. Definitely know the difference between a market and a limit order, especially the fees that accompany both. You need to protect your profits. Don't enter into lazy trades. Do not chase green candles. Be patient, wait for the market to show you opportunities. And lastly, no market correlations, such as the inverse correlation with Bitcoin and the DXY. Okay, so we'll start with number 1, assess your risk tolerance. Now, assessing your risk tolerance is a very important step in building any trading plan, okay? In general, there's really 2 types of traders. There's the risk averse and the risk tolerant. So are you more risky or are you more risk averse? There should be a happy medium in approaching this idea. However, you have to keep in mind, the more risk tolerant you are, you should be very well aware that you could lose your entire trading account. Okay, so do not trade what you're not willing to lose. Now, if you're unsure of your risk tolerance, in the PDF, I've included a link to the University of Missouri's risk tolerance quiz. It'll give you a better idea of what you will be comfortable with risking in your trading journey. Now, assessing your risk tolerance, it's a very important step in building a trading plan because it will impact your strategy, risk management, and other aspects of your trading. Okay, so number 2, very important, to keep detailed records, trading journals, and written records of all trades that you take, including your position size, the traded instrument, meaning whether it's Bitcoin or an altcoin, a stock, Forex, anything, your direction, long or short, entry and exit points, the result, and any other field you find useful. Now, regularly keeping a trading journal should be an important part of your trading plan, since trading journals can be very useful in improving your trading performance and spotting regular mistakes that lead to losing trades. Now, to help get you started in this chapter, if you scroll up to the top, you will see a daily TA journal, chart pattern diary, trading journal, and a trading plan template. So all of these are used to give you a basis for your own style and your own methods for record keeping. Okay, so even though you may not get into a trade one day, it's still a great idea to take notes on whatever asset it is you're trading and see what the price action and behavior is for that day, just in case an opportunity presents itself later on down the road, and you can use that information that you recorded to identify trading opportunities in the future. Okay, so you want to review these records that you take regularly, right? Why? I mean, what else is the reason for keeping records? You want to use that information to help you predict future price movement and identify future profitable trades. Okay, so I mean, naturally, every trading strategy will have a few losing trades here and there. I mean, it's just inevitable. There's no such thing as a perfect trader. But if you do find a recurring pattern in your losing trades, by reviewing your trading journal and your trading records regularly, you can take action to fine-tune your strategy and improve your results. I mean, for example, if you've lost a few trades in a row, was it because your stop loss was too tight? Or did you take trades that weren't in the direction of the underlying trend? For example, if you are shorting or short selling Bitcoin right now, what are you even doing? Why are you doing that? If you cannot answer that question to yourself, you probably shouldn't be taking the trade. Now, regular journal retrospectives will help you find answers to all of your questions. If you can't figure out why you're losing, this is probably why. All right, so important, number 4, know your strategy. This should take a ton of time and a ton of effort to put some effort into. You really need to know what it is you're doing and why you're doing it. So building a well-rounded trading plan is to know the strengths and weaknesses of your strategy. And you should know that no strategy is completely bulletproof. Some strategies work better when the market is trending, while some are designed to take advantage of ranging markets. Now, many professional traders use more than one trading strategy when trading the markets because they understand how markets change. Depending on what market you're trading, whether it's trending or moving sideways, you should have a strategy for trading that type of price action. Now, you want to define your confirmations of entry. Only accept trades that fit well within your predetermined criteria, and only accept trades that fit within your acceptable risk. And you're going to want to use the risk-reward ratio. There is a lesson in this chapter, so if you're unsure, just wait. That lesson is coming up, and we will definitely run through how to calculate that. Okay, so a simple but effective EMA strategy that any trader can use, and this does work. If you're trying to day trade, you can use this on a 15-minute chart. So plot 3 exponential moving averages on a chart, a 5, a 21, and a 55 period EMA on the chart. And the basic premise of this strategy is you're going to buy when the 5 period EMA crosses from below to above the 21 period. Now that would be a golden cross, and the price 5 period EMA and 21 period EMAs are all above the 55 period EMA. For a sell trade, you're going to sell when the 5 period EMA crosses from above to below the 21 period EMA, and both EMAs and the price are below the 55 period EMA. Now, a good place to put your stop loss would be place your stop loss below the 21 period EMA for a buy trade, or above in a sell trade. Now, a good thing to do is to write these confirmations down. And before you enter into a trade, as you see here in the PDF text, you can give yourself little check boxes just so that you are consciously aware of why you're entering into a trade. Very important here, do not break these rules for anything. Your intuition, especially if you're a new trader, you should ignore it because your intuition has no basis for being so. You need to develop experience, you need to develop knowledge, and you need to work your way through a couple of market cycles before you can really start to rely on any sort of intuition in trading. Because I promise you that your intuition now, when it's telling you to buy, is probably when you should be selling, and when your intuition is telling you to sell is probably when you should be buying. All right, so you're going to want to study the market environment. Again, it's really important to understand if you're in a bull market, bear market, uptrend, downtrend, ranging market, whatever it is, know your fundamentals. Number 6, very important to apply very, very strict risk management rules. So a trading plan without well-defined risk management rules is not really a trading plan, but it is a gambling plan. That is the difference here. So you need to understand very clearly what your intentions are, what your goals are, and how you intend to get to those goals. The trading journal that I've included with this chapter will help you get there. Now, one thing we can do is go through that at the end of this lesson, and I'll show you how to input your ideas into this trading journal and get a feel for how many trades you need to win each month to meet your trading goals. Okay. Number 7, again, before you enter into any trade, you should know your entry and exit prices. Number 8, you should have done this already, is defining your trading style, whether you're a scalper, a day trader, a swing trader, or a position trader. Okay, the most risk-averse trading style is likely the best for you to choose. Now, one thing you want to do is pay strong attention to market fundamentals, right? The reason you are trading crypto or trading stocks is because you are aware that they are going up in value because of the strong fundamentals that are present. Now, Forex traders follow things like GDP, inflation rates, unemployment rates, trade balances, government deficits, etc., really to get a feel for what country's currency may be gaining or losing value versus another one. Now, if you're a longer term trader and you want to take advantage of short term price fluctuations as a result of news, fundamental analysis should be an integral part of your trading plan and strategy. Now, in terms of cryptocurrency, using web tools such as Glassnode can really help when determining the potential bullish or bearish sentiment for price action. For example, an increasing number of active Bitcoin wallet addresses suggest bullish Bitcoin fundamentals. All right. Number 10, use a very precise risk to reward ratio. Now, you should have your very clearly identified entry and exit points for a trade. Before you enter that trade, these parameters will give you a risk to reward ratio. Typically, you'd like to start with at least a 3-to-1, meaning if you risk $1, you have a potential to gain $1, but you also have the potential to lose $1. Now, this principle is very simple, yet a lot of traders really refuse to follow it, and why I do not know. So only take trades that offer a very favorable risk to reward ratio. Yeah, the price might be going up, but is it worth risking capital in case that trade doesn't work out in the way that you had hoped? Define your maximum risk per trade. Now, another important risk management rule is that potential loss on each trade never should exceed a preset amount set in your trading plan. A lot of new traders will adjust their stop loss during the trade, which is a huge no-no. Have that stop loss set in stone before entering a trade, because if you're moving that stop loss and you're hoping that the trade works out, there's your first mistake. You're trading on emotion. Number 2, you're breaking your plan. Number 3, you are doomed to fail, and that trade will end up costing you much more in the long run, setting you much further back in meeting your trading goals than you really want to admit. Okay, so know your stop loss placement, as we just discussed. Define your confirmations clearly. For example, a strong engulfing bullish candlestick pattern signals strong buying and selling pressure and shows that the market is respecting these levels that you want to trade. Now, similarly, a close above the previous day's high or below yesterday's low can be used as a signal to enter into a long or short setup, respectively. So again, make sure you're defining your confirmations. If you have, an ascending triangle, for example, your breakout trading. So first confirmation would be price action breaks across the trend line, which would be the overhead resistance. And you are also looking for a volume confirmation. Okay, so there's 2 confirmations there, a break across resistance, a volume confirmation. You should define as many of those as you possibly can to increase the probability of your trade being successful. Okay, so understand order types. As we discussed a bit in the beginning of this lesson, knowing the difference between a limit order and a market order and the fees that come with both is very, very important. You can actually end up losing money by placing a market order versus a limit order, or sometimes you can actually end up paying much more for a trade in a market order versus a limit order. Okay. And then again, of course, you want to protect your profits and preserve your capital. In a bull market, if you're not trading, you are winning. Okay. If the price is going up, you are winning. So if you're losing, think about the exponential losses that will add up to at the end of your trading plan. Okay. And then the last one, Know your market correlations. So today's financial markets, they are literally all interconnected. When one market moves up, another market typically will either follow or move in the opposite direction. Now, there is almost no market that's completely independent of other markets. You'll notice a strong correlation between Bitcoin and the S&P 500, for example, or a strong inverse correlation between Bitcoin and the DXY, or a strong correlation between Bitcoin and gold. There's a bunch of reasons why these correlations exist. It's your job to understand why they exist and how you can use them to your advantage. All right. So that's it for this lesson. We are going to move into more components of a successful trading plan. The next one will be backtesting, a very, very, very important strategy to use to confirm the potential for success your strategy may or may not have. All right. So that's it for this lesson. Great job. Make sure you are always being protective of your capital. And that's it. Let's move on to the next one.